back to this week's Manager's Thoughts, coming to you from Kelly at Synergy Asset Management. Today is March 10th, 2023, and we're super excited to bring you another week of economic updates. This week was definitely an eventful week, so lots to talk about here. Markets were pretty fearful this week as Fed Chair Jerome Powell testified to Congress, was pretty bearish in his sentiment, and also did not rule out the possibility of bringing interest rates higher than initially anticipated. So that, alongside February's jobs reports and a bank failure, first failure in the last 3 years, that all contributed to a negative week. And so as of Thursday, March 9th, the S&P ended down 3.2%, the Dow Jones ended down 3.5%, the NASDAQ ended down 2.9%, and the 10-year U.S. Treasury yield ended down 1.3% for the week. On Friday morning, we got the jobs report for the month of February, like I just said, and so unemployment came in here at 3.6%, a little bit higher than January's 3.4%. It was also higher than the estimates of 3.4%. So just a small uptick from the last 2 months, but definitely still a very healthy unemployment rate. To put things in a little bit more perspective of where we are in the unemployment situation, just wanted to point out that even though we had that little uptick, it's definitely still really low unemployment. So here you can see where we were pre-pandemic, here we were post-pandemic, where we've been the last year or so, and where we are now. We are pretty low and definitely not cause for concern. So just wanted to point that out and show you where we are. We also saw average hourly earnings rise about 0.2% month over month in February, which was a little bit lower than estimates of 0.3%. On a year-over-year basis, average hourly earnings gained 4.6%. So employers are definitely still seeing higher wages than we did a year ago, but the rate at which employers are needing to increase their wages is definitely slowing. So here you can see in this chart just the average hourly earnings of all employees over the last 10 years or so and the kind of annual increases that we've seen. So here we are with that 4.6 there, and you can see that it's much higher than the trend pre-COVID here, below 4%. In addition to the unemployment data, as well as the average hourly earnings that we've got for the month of February this week, we also got Nonfarm Payroll. We saw the U.S. post a 311,000 job gain in the month of February, which was much higher than expected, but also slightly down from January's 500,000 job gain. February's jobs gains are pretty in line with where we've been over the last year or so. They are also down from where we were in 2021, but many of these job gains here were related to regaining jobs after COVID as people came off of unemployment. Another interesting fact of the February jobs report I wanted to bring up was that the labor force participation rate increased 0.1% to the highest rate since March of 2020. So all of this data is really pointing to a robust but slowing labor market that many are also hoping that will cool off sooner than later. On top of economic data, Fed Chair Jerome Powell spoke to Congress this week to provide the Federal Reserve's semi-annual monetary policy update. Markets were very squeamish as Powell indicated that getting inflation down to that 2% target goal is likely to be very bumpy with a long way to go, as the latest economic data is coming in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. Powell also noted that if the totality of the data were to indicate that faster tightening is warranted, that the Fed would be prepared to increase the pace of the rate hikes. So definitely a bearish sentiment coming from Powell there, but we look forward to hearing the FOMC statement next week as they decide on another rate hike, which is likely to be 25 basis points, but here Powell is not ruling out the possibility that the rate hikes go back up to 50 basis points. Our last piece of market news this week comes from California, where the tech-based Silicon Valley bank failed. So following the announcement of an urgent $2.25 billion capital raise by Silicon Valley Bank on Wednesday, depositors quickly pulled their cash out of the bank, causing a full-on run on the bank by Friday morning. This would match the second largest bank failure in the U.S. history by asset size, as the bank has over $200 billion in assets. This is also going to be the largest bank failure since the financial crisis if the FDIC does not find a buyer very quickly. Shares of Silicon Valley Bank fell sharply this week. You can see here it was down over 86% just in the month of March, causing the stock to pause trading on Friday accordingly. As always, we are constantly monitoring the news of economic data as it comes out, as well as the Fed, corporate earnings, geopolitical events, and inflation as these things roll out. So for each of our portfolios, like I said, we are constantly monitoring and using these economic updates to best manage our portfolios per their mandate and per their nature to best take care of our clients. Thank you for tuning into our Synergy Manager's Thoughts update this week, and we look forward to providing another update very soon.